To start on some of these big tech earnings. Not great news from Intel today, but if we take a look at one of these charts we have on the Bloomberg, those big tech shares just keep on rising. How much longer do you see this rally continue? And if you see pullbacks in stocks like Intel, do you add to positions at these prices?
Not on Intel, because I do think there is a fundamental weakness and a concern about their business model. So I wouldn't use this weakness for that specific company to jump in. For the mega cap story, I think it's going to be right until we really start seeing those rate cuts within the U.S. Right now, the expectation is that Fed is going to hold rates steady next week on next week's Wednesday meeting, and it's really going to be about that trend. And so the 10-year yield, the 5-year yield, those are really going to be the signals that are going to continue the trend that we saw for much of 2023 of the mega caps being the only area, with the exception of AI, that is continuing very much, whether you're a small or large cap. But as long as the Fed is holding rates steady, I think we're going to see that mega cap trend, and we're not going to see a broad participation within U.S. stocks.
Well, in terms of your rate cut expectations, we had a really healthy beat on GDP numbers earlier today in the US. We have a chart that illustrates that as well. Really blew expectations out of the water. What does this mean for the timetable, for your point of view, for Fed easing? I mean, is March off the table now?
I don't think so. I think given some of the other numbers that we've seen when it comes to core PCE, those are very good as well. So I think we could potentially see cuts within March, but certainly I think the idea of a soft landing is really becoming much more expected and perhaps much more really a possibility. I think, just one of the things that we're going to be facing is, as we go through the year, regardless of what the Fed does, is that because we are in such a political year, I think people are going to read into whatever they do with more of a political tendency, and that might affect how the market looks at things. So that sort of will add a little more volatility as we get closer to the presidential election as well, unfortunately.
When it comes to the sectors that you're investing in, though, when you have that environment where many people are still preferring the large caps, perhaps there's a lack of breadth in the market, you've still got this air of US economic exceptionalism, where should investors be looking to as sort of an alternative area or sector to invest in?
Right, because there are some really good opportunities that have been overlooked. I think we're getting close to 2 years now. And there's some areas that have some really exceptional growth within the large cap, particularly within healthcare and some of the industrials that are still trading at very reasonable valuations that aren't extreme. I also see that once we do get more comfortable with the idea of rate cuts coming in, certainly small and mid caps are trading at 3-year lows, well below their average when it comes to valuations, but still have very good growth rates that are equivalent to most of their large cap counterparts. So I think though there are those few exceptions like Nvidia and AMD that still just have exceptional off the chart growth and probably will continue to outperform the market. I think investors need to be willing to look outside of the box as soon as we have that transition and that shift and add a little breath to this rally.
But it's interesting because I feel like every time we go into a new year and we say that this is going to be the year that value outperforms growth, it doesn't actually end up being the case at all. So what's your view on that sort of dynamic as well?
Right. Well, we had a false start. We thought, right in December that we were starting to see some breath, and then that was going to be the beginning of the small and mid cap rally. And certainly, I felt, very much when you look at fundamentals, it makes sense when you're looking at what's happening, even when it comes to down to the economy or actually earnings beats rates. It all makes sense that we should be seeing better breath. So certainly this behavior that we've been seeing since about December 27th is a bit surprising, given that we're so long in the tooth and that we are looking to have the Fed finally change. I think that obviously is going to be expectation. But with regards to when that's finally going to happen, you really can use a lot of the U.S. Treasuries as your indicators. And so when we see that trend in yields go down, that's when that breadth is going to come. And it's been very closely correlated that when we saw the small caps starting to underperform was exactly when those rates changed their trend and went from going down to going up. So it's very easy to use the bond market as that indicator on when you're going to shift your investments on your equity side.
Here in Asia, the big story this week really has been the PBOC saying that it would cut the RRR for banks by 50 basis points, and we have seen that market reaction. I'm curious where you're sitting, how much this is coming up in conversations that you're having with clients, and the sort of recommendation you're giving off the back of that as well.
It hasn't come up as much. What we've been seeing more when it comes to discussion around Asia is really the rally in Japan. It's more been about that chasing that rally rather than those discussions. Certainly, I think there's still a lot of risk when it comes to some of their changes, and so I'm not ready to jump in just yet. I think we're seeing a little more safety with if clients are really wanting to jump into Asian and stocks rather than focus on emerging markets, that they could certainly use Japan as that proxy.